diesel is what drives the world.
Mm-hmm.
All transportation, whether it's truck, rail, distillates, you could take it as jet as well. And those cracks were already elevated because of inventories, and I know you'll dig into that further. But with potential for damage and potential for not being able to refine sufficient crude, I think cracks went over $60 last I
60.
checked, 64 today. And so most people look at crude and say, okay, it's $80, but really what bulk diesel would be like another 64 on top of that. That's the thing to worry about because that's what will really hit the economy. And that's part of the reason why we want to make sure that there's no continued disruptions because cracks are really what I watch from that perspective because that's where the demand destruction will happen and that's where economies start getting impacted.
Welcome to the Energy Desk, a podcast from Mobius Risk Group. In this series, we break down the macro forces and fundamental trends shaping global energy markets. We cover everything from geopolitics and policy to supply, demand, and the price risks that we're watching behind the scenes. Each episode is designed to cut through the noise and give you clear, actionable insight into what's driving today's energy landscape and what it means for what comes next. You can follow the show wherever you get your podcasts. You can share feedback or ask questions by emailing podcast@mobiusriskgroup.com. Let's get started. All right, Mohit, we're back on the Energy Desk, sitting here Wednesday, March 4th at just before 4:20 p.m. Central. And exciting week for crude markets, gas, and a whole lot of other stuff. So
Lots going on.
Lots going on. So where do you want to kick this off? We can maybe do a quick recap of what's been going on since Saturday and since our last chat.
That's a great place to start.
So Saturday, we woke up to news that the United States and Israel initiated their major combat operations against the Iranian regime and regional proxies and U.S. Operation Epic Fury, Israeli Operation Roaring Lion. They announced a few objectives, so destroying their missile capabilities, annihilating their navy, and ensuring that Iran does not obtain a nuclear weapon. And I guess the fourth objective is regime change. So the supreme leader of Iran was killed. Lots of the Iranian leadership, part of the kind of broad structure, the Beit, was killed in several waves of attacks. And the strikes within Iran are ongoing. U.S. and Israel are seeking to secure total air superiority over Iran and the impact on the crude market. So we'll talk about this at length throughout the rest of our conversation. But Strait of Hormuz, we have a roughly 90% reduction in tanker traffic from prior week levels through Wednesday. And price reactions, we have a pretty strong Monday and Tuesday reaction for crude benchmarks, products. We'll discuss all of this in greater detail. And today, after the announcement from President Trump that the U.S. would be doing some insurance and potential naval escorts for vessels in the region, we did have kind of a steady performance for crude benchmarks. So Brent finished a little bit down. Right now, sitting just about 82.60, and WTI front month finished little change today, so about 74, a little over $74. And so extreme backwardation, and we'll dig into all of that, but that's kind of just a rough overview, and maybe we can dig into something specific here. So what have you been watching? What have you been thinking is the most relevant for the market and for any of our listeners?
Yeah, I think we've talked about this before. The most important was the Straits of Hormuz, and that still is the biggest choke point. And that's part of the reason why US and Israel went in and they wanted to take out all their capabilities, whether it is anti-aircraft, whether it is missile, whether it's a drone, and the Navy. So they are pretty far along on that from what I read. If you compare the first couple of days, what they were shooting at US, Israel, and the Middle East versus what they did in the last 24, 36 hours, it's down at least 50%, if not more. So that is an indicator that a lot of that capability has been removed. And I think from there, then it's a question of, okay, what happens? I know we were talking earlier that all the insurance companies had said, okay, we're not going to insure any of these ships. And that was part of the problem because so much oil and so much other stuff goes through there. And then yesterday, the administration said, okay, here's the agency which is going to give insurance. And if necessary, the convoys will be escorted by the Navy. And I think that caused prices to come off. Like, I think it was almost a $4 or $5 reaction. And then today it was, like you said, pretty close to unchanged. And it was also helpful for financial markets here. I mean, we saw that in all markets, they were all up because that is really what we need is some kind of ability to keep things moving through that strait.
Yeah, I think that's important to dig into. So, Strait of Hormuz, obviously the most notable at the moment is the petroleum flows that go through the Strait of Hormuz. It's about 20 million barrels a day. And as you mentioned, we did have some vessels hit by various projectiles from Iran. I think it's about half a dozen, maybe a little bit more, that actually sustained any type of damage. But the more important thing was the insurance. And so Lloyd's London and all the other insurers said we're out on this one, and so that really drove really the bulk of the disruption. And I think it's important as we discuss this, there is a lot of conflicting information about how much traffic is actually going through the strait. And a big part of that, I guess, uncertainty is that a lot of the vessels have turned off their AIS responders. And that is something that we've seen over the past several years with the shadow fleets. So Iran, Venezuela, Russia, the shadow fleets that they're using, they're turning off their AIS responders. So they're more difficult to track by kind of ordinary means. And so you have to rely on satellite imagery and some other methods to get a better estimate of what's going through. But the reality is that you have probably a 90% reduction in Strait of Hormuz tanker traffic. We still have some of those vessels going through, but it really is just kind of a trickle at the moment. And as we kind of look ahead, as you mentioned, yesterday afternoon, President Trump announced that the U.S. International Development Finance Corporation, DFC, is going to provide some of that insurance and other financial kind of backstop measures. And then the naval or the Navy, U.S. Navy, will potentially be escorting vessels through if there are other kind of concerns. So we're potentially on the precipice of losing some of the Strait of Hormuz related risks. And that, I think, will be a very interesting thing to watch through the week, because just based off of the 2 days, so Monday and Tuesday, or really 3 days, Sunday through Tuesday, where we had expectations for further disruptions from where we were already. Had Iraq announce at this point, as of today, 1.5 million a day of production curtailments. They halted exports on the 200,000 a day Kirkuk-Ceyhan pipeline that really facilitates the production from Iraqi Kurdistan to get that to the Mediterranean coast, Turkey's Mediterranean coast. So that's taken offline. And then you have kind of some more, more broad risks of production curtailments for Saudi Arabia or UAE if this is a sustained disruption. And so for kind of the big players in the region, so Saudi Arabia producing over 10 million a day, and Iraq was over 4 million a day last month, Kuwait 2.6, UAE 3.4. So you have a lot of production in the area. And importantly, you also have a lot of the global spare capacity in the area. And so if that's all trapped inside the Strait of Hormuz, it's effectively rendered useless. So the risk is certainly there. But as we kind of look ahead, if we do get some clarity on how the insurance and potential naval escorts will go into effect, then you start to potentially pull back on some of the production curtailments and a lot of the risks that are there. From this point, what are you kind of watching through the week beyond kind of the insurance and Strait of Hormuz side? What have you seen on the financial or other market developments that you think are really notable?
Yeah, coming back to financial markets, I mean, when markets opened on Monday, the worst hit were the Asian markets like Korea, and it made sense because they're very, very dependent on imported oil and gas. And with the Qatar outage or curtailment, TTF was up almost 50%. So they were going to get hit both ways, gas and oil. So I would expect that as things stabilize, those financial markets will normalize, or at least get closer to normalization in terms of what I'm watching now is how desperate does Iran get? And one of the things that I was reading about, I know you mentioned how everything oil wise and how much of concentration there is. But if you think about how the Middle East countries get their food, something like I was reading 85% of that is imported. So I hope it never gets to that point where they start targeting civilian infrastructure. But the things that come to mind, besides the refineries, which they're still trying to take out, is desalination plants, because 70 to 80% of the water is from those plants. Power plants, which again, without power, they can't run the desalination. And then imported food. So those are the things which I'm really watching. And I know they're going to be protecting those, but those are the sort of
Potential levers
additional
for
potential
destabilizing further. Right.
destabilizing issues. Yeah.
Yeah. Yeah, and I think so. There's many aspects of what you just mentioned that I think are worth digging into. But on the gas side, one of the most notable headlines or some of the takes that are out there about the Qatar's LNG. So they shut off liquefaction today, and that's most likely going to result in a multi-week process to bring that back to normal levels when this does resolve. And there's a lot of commentary about why the U.S. is not necessarily being hit by that. U.S. natural gas, so NYMEX natural gas, is not reflecting kind of the broader global concerns about LNG. And I think it's just important to mention that right now, U.S. LNG is running near operational maximums. And so there's not really any further capacity for the U.S. to participate in the global LNG market beyond where we are right now, which is about 20 BCF a day. We are going to get some new capacity additions with Golden Pass and Corpus Christi Stage 3 Train 5. Both of those are now in their commissioning phase. So we'll have incremental supplies, but it's not going to be anything material. We have 10 BCF a day of Qatari LNG that is now offline. So it'll potentially, I think, be something that we see downstream consequences into summer injection season, particularly for Europe when they have their current storage levels below 30%. So just something to watch, but the consequences for US natural gas markets, I think that's important to clarify that it's not really going to pass through immediately. So this is really, as you mentioned, the crude petroleum side, food, and more kind of regional stability and the potential consequences there. When we look at some of the kind of refinery and product considerations, we have Saudi Aramco's Ras Tanura. So this is a export terminal, but also they have a 550,000 a day refinery that was targeted but was not damaged. They did take it offline as a precautionary measure, and as of right now, it is still offline. But that combined with the disruptions to the crude exports, particularly to Asia, you have some kind of effects on the Asian refiners where they're having to shut down capacity now. So really, I think the biggest consequence of the current situation is in the product markets.
Mm-hmm.
And what are you seeing for product cracks? And I think maybe we can dig into some of the inventories, positioning, and
Right.
cracks out of this.
Yeah. I think diesel is what drives the world.
Mhm.
All transportation, whether it's truck, rail, I mean, distillates, you could take it as jet as well. And those cracks were already elevated because of inventories. And I know you'll dig into that further. But with potential for damage and potential for not being able to refine sufficient crude, I think cracks went over $60 last I
60.
checked, 64 today. And so most people look at crude and say, okay, it's $80, but really what diesel, bulk diesel would be like another 64 on top of that. That's the thing to worry about because that's what will really hit the economy. And that's part of the reason why I want to make sure that there's no continued disruptions because cracks are really what I watch from that perspective because that's where the demand destruction will happen and that's where economies start getting impacted. In terms of what else happened financially, I mean, we saw massive backwardation very quickly. And the reason for that is all the producers are looking to sell the banks. Most of them were already done with
For
26 and they were looking to do 27, 28. And all the buy interest was in the very front because that's where the specs were short. I mean, they were still somewhat short coming into this. And so they're trying to buy where there's liquidity, which is the very front. And so you've got a mismatch between the tenor of who's buying and who's selling. And that's why some of the producer calls we had, it's like, oh, I want to do this in 27. It's like, well, it's up 25 cents. Like, but the front is up $10.
Yeah. 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 When we looked at that today, so that the data that you had on that was, I think is perfectly illustrative for what we're saying. So what was it? The front 4 months were really what captured most of this. So what did M1, M2? How was M1, M2 impacted?
It was, I think all those front spreads, they were like $1, $2 type. And I think Brent was worse. I say worse as in it was more steeply backwardated.
Yeah. Yeah. And so as we saw today, the reaction to yesterday's announcement from President Trump with the insurance, like we discussed, and also, some unconfirmed reports that Iranian intelligence members had established some dialogue with the CIA to start talking ceasefire terms. Still unconfirmed on the latter portion there. We did see the Cal 27, Cal 28 WTI were up about 75 to 80 cents
Mm-hmm.
versus basically a dime at the front, and is kind of up and down throughout the day. It's definitely an interesting dynamic to watch. And I think on the product side, as you mentioned, just going back to that real quick, the difference between the distillate and gasoline developments that we're watching, and even in cracks. So for U.S. inventories for distillates are about the 25th-ish percentile. So I'll pull up the most recent numbers after today. We have U.S. distillate stocks, 120.8 million barrels. So that's the 30th percentile seasonally adjusted relative to the last 10 years. And gasoline inventories are sitting at 253.1 million barrels, and that is the 82nd percentile relative to the last 10 years, seasonally adjusted. So the risks are not evenly distributed between products, and you, I think, are seeing that reflected in cracks. As we mentioned, $64 for prompt diesel crack and $30 for prompt gasoline. So, I think that will be an interesting trend to watch through the week. Kind of looking more broadly, the other, I guess, levers that can offset some of the immediate risks for kind of a sustained, at least through this week, sustained disruption to Strait of Hormuz flows. I think it's important also to mention sanctioned barrels. So you had some points on this in one of our calls that I think would be good to highlight again here.
Yeah, for sure. We have a lot of floating barrels which are sanctioned right now. And if they could be allowed to land, so for example, Russian barrels able to be absorbed by India, just as an example, that would alleviate a lot of that shortage or temporary shortage, which you're seeing right now. So even though those floating barrels have come off some, there's still plenty out there. That's an easy lever to sort of pull.
Yeah, you've got basically 140 million barrels of Russian crude on water, and then you've got another 46 million or so of Iranian barrels on water. And for India, go ahead
I
if
don't
you
imagine they'll let the Iranian barrels land, but you do have Venezuelan barrels too, right?
you do. Yeah, and for the Iranian barrels, the thought is more for Iran's primary buyer, China, if they are going to dip back into the market, which, while we're discussing inventories, Chinese onshore commercial and strategic inventories are at 1.2 billion barrels. So they are near all-time highs, and whether planned or not planned, they are in a good position to kind of pull back, go into refinery maintenance season a little bit earlier, and maybe just kind of pause before they resume their opportunistic purchases. But on the export, so just looking at the Russian barrels, I just want to pull up some of the latest trends in that when you're mentioning India. So India's imports of Russian crude in the final month of 2025 averaged 1.4 million barrels a day. And over the last 5 weeks, that has dropped to 500,000 barrels a day. And so that's part of their agreement with the U.S. to cease those imports of Russian crude in exchange for the U.S.-India trade deal. Meanwhile, or conversely, rather, Chinese imports have averaged in February, full month February, about upwards of 2 million barrels a day. And that's up, essentially taking up all the slack from India. Yeah, it's essentially a 500, 600,000 barrel a day difference from where they were before the India trade agreement. So, I think that will be a potential buffer. And as you mentioned, Venezuela adding to that for India, and that will be something that will play into Europe's product market as well. And that's been a big concern for Europe. You're seeing gas oil have a very strong reaction to what's going on, just like you saw in TTF for gas. So yeah, what else would you like to highlight so we don't have to dig into all the stuff that is going on? But
Yeah, the one other thing I definitely want to mention is, given how much the curve is steep and how hard prices have run to the upside, you're at a point now, and how much positioning has changed. You've gone from net short to net long Brent and products. If things do stabilize, there's a lot of air under the market. So it can come out in terms of price, shape, volatility is high. That can sustain because now you've got both way volatility. It can go down, it can go up if there's some outage, but positioning being long now, there could be a rush for the exits if things start getting stable. Or like, okay, I think this is fine. We don't need to be up here. And then there
yeah,
could be a rush for the exit.
yeah. And adding to that, or I guess a component of that reaction, is also stemming from the OPEC 8 announcing a larger than expected hike for April. So they announced a 206,000 a day hike to their April production quotas versus kind of the original reported 137,000 a day that they were planning ahead of all the conflict kicking off. So you have potentially more OPEC 8 supply coming online, but adding to the announced hike, you're also having a normalization of Kazakh production. So they had outages about 900,000 a day for January, most of February. So that's going to be normalizing. And then, related to that is the CPC exports. So exports from the CPC terminal in the Black Sea, those are going to be up probably 800,000 a day from the kind of January average after they restored that second mooring point. So the kind of January, February fundamental picture was altered substantially by those unplanned outages in Russia, in Kazakhstan, and a few other regions. And so as that kind of bulk, probably 1.2-ish million barrels a day of supplies is already coming back, you're going to have another 206,000 a day added to the OPEC 8 production quotas, most of that coming from Saudi Arabia, Iraq, and a couple of the others, not Russia, not Kazakhstan. So potentially would have kind of a sharp change in the fundamental picture as you have a rapid de-escalation on the geopolitical landscape. So it'll be potentially a very, very dynamic couple of weeks ahead. Yeah. Well, awesome. I don't think we need to dig in too much more because I'm sure everybody listening to this is paying attention to what's going on. But if anybody has questions, would like to discuss more specifics, portfolio specific opportunities, anything like that, please do not hesitate to reach out, and we are always happy to chat about what's going on in the market.
Yeah, exactly.
Awesome. All right. Well, Mohit,
all right. Thanks, Alex.
Thanks for hopping on. Right.
Yep. Bye now.
Thanks for joining us on the Energy Desk. Please keep in mind this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.